Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
JPMorgan planning to bring staff back to office 5 days a week.
In that brand new office building.
Yes.
On Park Avenue.
Like
Exactly
Paul's been
right.
waiting for this headline for 4 years.
Exactly right. So JPMorgan, and how quickly will the others follow?
Very quickly.
That's what I'm kind of thinking here. So.
5 days a week. But I have a question. You have to wonder, will there be some flexibility? Like if you're like, hey, I need to work at home a couple days. Like, is that more generally accepted?
I think what it's going to be is you're going to be more willing to ask for it. And I think the manager will be more willing to give it.
Right.
But it's like, I need a day here, maybe 2 or 3 months later, I need another day there. Whereas before, maybe I wouldn't have asked for that flexibility. And as a manager, I may not have given that flexibility. Now I think that flexibility is kind of there.
But
well, now
unlike
you get to work in the Death Star, though, which is what everybody seems to
is
call
calling it.
Yes.
Oh, that's funny.
It looks very cool.
Let's stay on Wall Street for a second. So the other news of the morning, one of the top read stories on the Bloomberg terminal is Bridgewater. That company cutting 7% of its staff in an effort to remain nimble. Michael Moore, managing editor for finance in the Americas, joins us. But hang on a second. JPMorgan, 5 days a week, you surprised?
No, not really. I mean, the majority of their staff was already doing that, but this would be the rest of the staff. So we've seen some firms move in that direction. Others, have used the flexibility as a recruiting tool.
Citi has.
Yeah, Citi has stuck with 3 days a week for a good portion of its staff. So I think we will see a difference among the firms. Some of the European firms have used it as a recruiting tool. So, but Jamie Dimon has been very vocal about his views that people work better in the office together. It helps develop talent. So, I think it will be kind of leader by leader, kind of setting the agenda.
I don't know. I mean, the fact is, it does work from home, so that does work. But let's get people back, so we'll see how it goes. Bridgewater Associates, huge hedge fund, cutting staff. Is this just the normal culling of people, or something different going on here?
Yeah, it's an unusual one just for the reason that they are coming off their best year in many years for the flagship fund. I think the new CEO is definitely trying to shake things up a little bit. He has replaced some of the top management. They've brought some people from the outside, which they hadn't historically done under Ray Dalio. So I think this, the stated goal here is there are some areas where they want to hire. They don't want headcount to get too crazy. This kind of brings them back to where they were, a little over a year ago in terms of headcount, and allows them to kind of be a little more selective.
Did they overhire or something, or did they just want to just move focus or something like that?
Yeah, I think you have seen them announce some efforts on the AI front. They may want to do some more hiring there, but we have seen some of the hedge funds more broadly do some overhiring. There has been a talent war, so this could be a bit of a correction there.
It's a unique place to work, isn't it? What's I've heard that. What makes it unique at Bridgewater?
Well, they have this they've long had this culture of radical transparency, of being very blunt with each other. A lot of the senior people have been there since they were in their early 20s, have grown up there, haven't worked elsewhere. So there is a bit of an insular culture there. I think Nir Bardea, came in a little bit later in his career, so brings a different perspective than Dalio, who built this place, around his principles. So I think you could see a bit of a relaxing of that culture while still, being kind of a unique beast out in Connecticut.
Going back to JPMorgan for a second, not about the 5 days, but JPMorgan, the latest bank to quit the climate finance group. This follows Citi, follows B of A. How are we understanding it? Is this like a complete backlash against climate and DEI, for example? Or is this just sort of like we're going to move to the middle, or are we just rebranding it?
I think it's a bit of rebranding. I think they were getting a lot of heat from some politicians over some of these pledges. They wanted something with
and these are pledges like we're not going to lend money to oil and gas kind of thing?
That's how they were perceived. They weren't always written that way, but that's how they were perceived. That, they got the CEOs when they were in front of Congress a little over a year ago. J.D. Vance made a big point on this. So I think they thought we can do this in ways of lending to renewable energy without taking such a public stance that will get us a lot of political backlash. So I think you'll still see efforts on this, but they won't be as grand as this climate pledge that they had all signed up to.
What is this? I mean, the timing is not a coincidence, I'm assuming, given the new administration coming in. Is that how it's being read, or are they saying anything about that, the timing?
I don't think it's a coincidence. Right. I think the political winds have shifted on this. And in general, I think there is, these pledges always kind of came with an understanding of, okay, we need to help our oil and gas clients transition to this new world. So it's not going to be, cutting ties with the big oil companies. But I think they're being more cautious in that.
And it's not just, banks. We should point out McDonald's today, the piece coming out saying that it's walking back its DEI goals, saying it's changing its approach to diversity, equity, inclusion, no longer setting, quote, aspirational representation goals, instead focusing on embedding inclusion practices into its daily business. I don't know what that difference is, but that's why I wonder if it's just to rebrand. Like, now you don't want to say ESG, but if you still have some sort of net zero goals, maybe that terminology is more okay. It's just sort of a branding and moving away from something extreme.
Yeah, I think it's not wanting to be seen as taking a political stance, more taking this is good for our risk perspective.
I guess it feels like it's been, across the economy, maybe peak woke at some point, or peak DEI. I wonder if the pendulum, as you said yesterday, the pendulum just swinging back a little bit. So we'll stay on top of that. Michael Moore, thank you so much. We appreciate that. Michael Moore is managing editor for Finance in the Americas, Bloomberg News, joining us here in our Bloomberg Interactive Brokers studio, looking at that story. Bridgewater, big hedge fund, cutting about 7% of its workforce in an effort to remain, quote, nimble. So there you go.
Yeah.
Now, it's also, I think when you look at some of these hedge funds, they're starting, we've seen some hedge funds return capital to investors because they're just getting too big and they can't find the opportunities to invest the capital and generate the returns they want. So let's just give it back. And that's what we've seen in the hedge fund business over the last 20 years has been the funds, more and more money is going to fewer and fewer big funds, and they're just getting bigger, whether it's Point 72 or Citadel or some of those types of people. On
the flip side, not every hedge fund is doing well. Hedge fund Hedera Jupiter has suffered its worst ever losing streak, got a 32.7% decline last year. This follows a 43.3% plunge in 2023. Yikes. Yep. Assets at the firm have fallen to around $818 million. 2 years ago, it was $5 billion.
Yeah, that's not good.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The ISM Services Index data came out. Looks like better than expected. And we want to get right to that ISM data because that's something that's kind of moving the markets here. Yields popped a little bit higher here on the back of some of that economic data. We got the 10-year Treasury now up about 5 basis points, 4.67 on the news. Stocks pulled back. Also, S&P down just fractionally. Steve Miller joins us. He's the chairman at ISM. That's the Institute for Supply Management. Hey, Steve, talk to us about this ISM data. Alix and I are looking at this and looks really strong across the board. What are you seeing?
Yeah, same thing. What drove the increase this month was business activity and supplier deliveries. Kind of offsetting that a little bit, we're seeing a continued drawdown in backlog of orders, but with the lower disruption in supply chains that we've seen in the month, it kind of makes sense.
Any of this related to the potential of tariffs coming on in 2025 or 2026?
Well, some of the inventory activity seems to be a result of concerns over tariffs. By far, the commentary that came through from the respondents was concerns over what tariff impacts might have. And I think we saw some of that in the sentiment around pricing. Pricing, we saw quite a lift month over month.
ISM Services prices paid came in well above the forecast, well above last period. How do we interpret that?
Yeah, I would directly relate that to some of the pricing activity that's coming in for next year's contracts.
Okay.
There's risk management around tariff impacts, and we saw some of the commentary talking about price increases in anticipation of what impacts there might be from the tariffs. And it was across it was 14 of the 18 industries had commentary around potential negative impact from tariffs.
So could this be the peak then for services? Like, how will that feed through?
Yeah, I think that we'll see, based on the supplier, the supplier deliveries number impact, we'll see that drop down again in January, assuming there's no port strike. Yes. And that'll give it a little bit negative pressure on the overall PMI. But this quarter is the strongest quarter we've had in a while. I believe it's since the beginning of 2023. I feel really strongly about where the number is. It's really solid growth.
All right, Steve Miller, thank you so much. We appreciate that. Steve Miller, he's the chairman of Institute for Supply Management. That's ISM with some strong numbers.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through a lens of our Bloomberg Intelligence folks. They cover 2,000 companies, 130 industries around the world. We also tap a vast network of resources outside of Bloomberg as well. Mike Sommers is one of them. He's API, American Petroleum Institute President and CEO. Talks to Washington about what to do about energy. And Mike, your claim to fame right this second in this radio studio is actually Landman on Paramount, because Paul, my co-anchor, is watching it. And now he loves it, and he thinks he knows everything about oil and gas, and he's all over it. So you're right. API is one of the sponsors. Yep. So perfect day. Good to see you, Mike. What's day one for you guys?
It's a great show, and I appreciate being with you today.
What's day one for you guys under a President Trump administration?
Well, we've laid out an API 5-point policy roadmap. You can find it at api.org of the things that we're asking this president and this Congress to do during the first 6 months of the administration. But there are some things that they can get done early in the administration, really on day one. So one of those things is lifting the LNG export pause. We're excited that we have a new president that's focused on that, and he's committed to lifting it on day one. So that's one thing we think that they can get done very quickly. The second thing that we think they can do is they can authorize a new 5-year leasing plan in the offshore Gulf of Mexico. We need a 5-year leasing plan that prioritizes new leases in the Gulf of Mexico, which continues to be a prolific region for the American oil and gas industry. About 14% of American oil comes from the Gulf of Mexico, which is why what President Biden did just yesterday in setting aside new acreage that we will not be able to develop was so concerning and so disappointing. Another big thing that we're focused on is repealing the EPA tailpipe mandate, the EV mandate that they put in place early in the Biden administration, and we'll work with the Trump administration to get that repealed and replace the CAFE standards that are draconian and U.S. automakers can't meet. So those are three of the key priorities that we want to focus on early in the administration. And then in addition to that, we need to get a new tax bill in place before the end of 2025. We're prioritizing things like the corporate tax rate, of course, and then really focusing on how we continue to build American geopolitical strength by expanding energy trade throughout the world.
Green energy, how does green energy work with traditional energy? I'm not sure what the preferred term is for oil and gas, but how does green energy work with oil and gas and traditional energy sources?
Well, the truth of the matter is that we know that we're going to need all sorts of energy to meet the energy needs of the future. If Goldman Sachs is right, and we're going to need 10% more energy for the next 10 years to support data centers and AI growth, we're going to need all sources of new energy, which is why it's important that we get a new permitting bill in place so that we can build out not just oil and gas pipelines, but new transmission lines for those new energy sources as well. The great thing about natural gas in particular is that it can support these alternative energy sources sources as well. Because we know that the wind isn't always blowing and the sun isn't always shining. You're going to need something to back that up. And natural gas is almost always the preferred energy of choice when backing up those sources. So we know that we're going to need more energy. We don't just need all of the above, but more of all if we're going to be successful in leading the future, particularly when it comes to AI. So we want to work with our partners in the other energy system to make sure that we can continue to expand.
So,
but
Mike,
we also know,
I was going to say that a popular talking point for Republicans was that we need to get rid of the Inflation Reduction Act. But if you dig into a lot of the details, a lot of the oil guys and natural gas guys like the Inflation Reduction Act and things like carbon capture credits, right? 45Q, new rules on the hydrogen tax credit, 45V were unveiled that people were pretty happy with because it had a broader swath of the energy that you could use to make hydrogen. Are you guys happy with those things right now?
I actually feel pretty good about our ability to defend the 45 tax credits. Q and V are the ones that are most important to us for carbon capture and hydrogen. We were pleased with the Biden administration rules, though we think they could be improved under President Trump on both CCS and hydrogen. So we'll work with the Trump administration to improve those. But there are provisions, I think, that under the Inflation Reduction Act that are vulnerable, particularly the funds from the Loan Program Office, which has just become a giant slush fund for favored industries under the Biden administration. So I do think the funds that haven't been obligated yet under the Loan Program Office are very vulnerable as Congress looks towards reconciliation. So that's where I think most of the focus will be.
But some of the money from the Department of Loan Office is going to like companies that produce, say, nuclear or have natural gas. Like it's not just like rando green technology. How are you going to distinguish that? Because if you need the loan in order to, say, restart a nuclear plant or work into small modular reactors, for example, what do you think about that?
Well, I think that's going to be something that Congress is going to have to sort out, and the administration is going to have to sort out. I'm pretty sure that at the beginning of the administration, what they're going to do is they're going to freeze all new funds coming from the Loan Program Office until they get a better sense as to what to leave in and what to leave out. And that'll be up to the new Energy Secretary, Chris Wright, and I'm confident that they'll be able to figure out what they should focus on and the things that they need to leave behind. But that'll be up to the administration. Our focus is going to be on advancing a reconciliation bill that supports American energy. That means new leases in the offshore, new leases onshore, reopening Alaska, which President Biden has taken a particularly focus on in terms of cutting off the amount of oil and gas that we can produce in the state of Alaska. So we're confident that we're going to be able to prevail on the administration and the Congress to advance new leasing priorities as they get that big new reconciliation bill done.
Have you heard, what have been, I guess, maybe any rumblings coming out of this new Trump administration about how aggressive they plan to be as it relates to oil and gas?
I think they plan to be very aggressive. I mean, as you know, the president has really focused on how do we continue to grow this tremendous American resource. We're producing about 13.4 million barrels of oil every single day, which is a record. We're producing records amounts of natural gas, but we also see record demand for these products. Not just record demand for oil and gas, but also record demand for coal and other sources as well. And that's because we're starting to see this the demand continue to increase. We're in a different era than we were during the first Trump administration, where energy demand was relatively stable during the first Trump administration. Everything's changed in the last 8 years, where you have new sources of demand growing. Data centers, of course, AI, more things being plugged into the electric grid. So I think what President Trump understands is that we're going to need a lot of energy going forward if we're going to win the energy security race.
Hey, Mike, it's always good to catch up. So many more things to talk about. We'll get you back. We'll go through them also. I'm really questioning how we're going to get pipelines built. So next time we'll tackle that. Mike Sommers, API President and CEO. And I should point out also the sponsor of Landpan on Paramount Plus. Well, not Mike, but the API. That feels important to say.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
In the meantime, we're seeing ramped up pressure on Chinese companies and their relationship to the U.S. There's a growing backlist of those Chinese tech giants, and it's happening pretty quickly. Enda Curran is Bloomberg Global Economy Reporter. We got news about Tencent just in the last 24 hours. Where do we stand today versus where we stood like 6 months ago?
So it's another day, another series of companies being added to this list. As you mentioned, Alix, it's basically a list by the US government that says these Chinese companies are working in collaboration with the Chinese military. And although it doesn't apply sanctions on those companies, it will make it awkward for US companies to do business with them. And as you mentioned, we've had some new additions. Tencent, probably one of the best known internet companies in China, and best known for its apps and its gaming, for example, not known to be in the military civil fusion space, but has been added to the list nonetheless. And some of the hawks in DC have been calling for that to happen. CATL, which makes the batteries for the big EV car makers, including Tesla, that's gone on the list with potential ramifications for the supply chain story there. There's also a shipping company, Costco, and some other big well-known Chinese companies as well. Now, of course, the Chinese authorities in Beijing have responded. They say they hope the US will undo this wrongdoing. And of course, we know China has options of retaliation of its own. They've been expanding their own kind of so-called entity lists as well. So it's just another example of the ongoing tensions between both and the tit for tat between both governments as well.
I mean, will the government undo this on January 20th?
Well, it's a tricky one because you would assume the incoming Trump administration are as hawkish as the Biden administration, if not more hawkish. You know, everyone's trying to out-hawk each other on China at the moment, Alix. So I don't know whether or not there will be a reversal. Obviously, there's a complication there with CATL being so critical to the Tesla supply chain. So that will be one worth keeping a close eye on. But broadly speaking, though, you'd have to say the direction of travel when it comes to export controls or investment restrictions, or potentially tariffs on goods made in China, coming from China into the US, and curbs on doing business and people flowing the like, that's all been going in one direction. So the Biden administration seems to be cementing its own hawkish legacy, putting its own stamp on this before they finish up. And it's kind of hard to imagine too much of this being unwound by the Trump administration.
So I guess then the obvious question is who's next? And I don't know if we know that, right? Like you mentioned Tencent, like that was kind of a surprise over the last 24 hours. But sector-wise, company-wise, market cap-wise, who do we think might be next?
Well, it is hard to say, Alix, because like you say, we've gone now from, if you might say, maybe obvious companies who you could say are clearly aiding, or where the US doesn't want to aid China's technology aspirations, its chip aspirations, its AI aspirations, to companies that aren't necessarily in that space. So certainly it's been broadened now. That list looks like it's been broadened. So, you know, it could go anywhere from here. But the real question is, when the Trump administration comes in a couple of weeks' time, what will their initial focus be? Will it be on goods trade? Will they go hard with the tariffs, which the President-elect Trump has obviously spoken about so many times? Or will they get off to an early start also with ongoing investment restrictions, export controls, restrictions on technology and the like? And if it's that, then that's where we will see this list coming under more scrutiny again in terms of where they do go with it.
Any response from China in terms of how they retaliate in this particular kind of instance?
They had, well, the foreign ministry overnight did respond to say that, look, they obviously disagree with this. They want the US to undo it. They refer to it as wrongdoing. But we know that China does have options to retaliate. They've developed something of an entity list of their own, Alix, where they're putting US companies on their list, where they're making it harder to do business with Chinese companies, putting restrictions on the flow of, say, critical minerals, resources, that kind of thing that US companies might need. So China has options to respond where they are in this space. But there's also been some mixed mood music coming out of Beijing. They've been saying that when it comes to goods trade, at least, that, you know, they're open to listening. There could be some negotiation or deal to be done on that side of things. And I think that's why this China-US trade story is going to be very much an evolving one as the new administration gets up and running.
When you take a look then at how that does evolve, does China then wind up shipping more stuff to, say, other G7 countries, and then it winds up having this weird supply glut elsewhere, and then how that affects trade dynamics within the U.S.?
Yeah, the trade dynamics are definitely being upended at the moment. As you say, you know, even if China comes under tariffs or export controls or restrictions with the US, they either find new markets, to your point, or they shift some of that production over to third-party countries, and then from there they ship to the US and kind of skirt these controls. That's been an ongoing issue, and that's probably one that's going to come under scrutiny, I think, when the new administration comes in. And that's partly why some people think universal tariffs are being talked about this time around in terms of trying to make sure China doesn't come through those loopholes. So, if you think back to the first Trump administration, those tariffs were kind of broad brush. They were continued by the Biden administration, but there's a feeling that this time they're going to have to be more surgical and make sure that those loopholes are closed.
All right, Enda, always good to catch up. Thanks a lot, Enda Curran, Bloomberg Global Economy Reporter, joining us there. Speaking of, 11 o'clock, we'll take bets on whether or not it actually is 11. We're going to have President-elect Trump remarks from Mar-a-Lago in Palm Beach, Florida, so we'll bring that to you. And then around 11:30, we'll have Jensen Huang of NVIDIA speaking to Ed Ludlow. We will also be updating you on those headlines as well.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.